And for more on the markets, let's bring in Eddie Gabor, co-owner at Key Advisors Group. Eddie, good morning to you. Thank you for joining us on this Tuesday.
Good morning.
Stocks finally pulling back a little bit this morning after this massive rally. Anything behind that pullback, or just taking a bit of a breather?
Just taking a little bit of a breather. I mean, right now, the bottom line is this historic rally has caught many off guard. Look, myself included, in regards to how high it's gone in such a short period of time. And as the old saying goes, you can't fight the Fed. And with the amount of liquidity the Fed has put into the system, that, and I think the game changer here near term, which is going to give this market a lot more steam possibly, is the jobs number that came out on Friday was just a shocker. I mean, to go from 8.3 million job losses estimated by many economists to a positive 2.5 million shows that the opening of these states are heading in the right direction. And I would only expect more positive news to come as more and more states open up here in the near term. So the path to least resistance in the short term is going to be upwards for the markets.
The National Bureau of Economic Research revealing that the U.S. entered a recession in February before lockdowns really were in place. Is that a surprise? And what does that tell you?
Well, it's not a surprise knowing what we know now, because we did last year, if you remember in the summer months, we had the inversion of the yield curve. CapEx spending wasn't as strong as we had wanted it to be. So there were some signs that there were cracks heading into 2020. And then obviously with the virus and the shutdowns, it just kind of accelerated things. And so it made the recession happen so steep and so fast, which is why some now are predicting that it may be the shortest recession that we've had. But look, there's still a lot of unknowns out there. There's a lot of debt that's being accumulated right now. So long term, there's still some issues fundamentally. But here in the short term, again, the momentum is behind the bulls with the amount of cash on the sidelines. And again, the positive news coming from these states.
On that note, we talk about the recession. I know you just said it could be one of the quickest that we've had, which would be great news. How long do you think that the recession will last? And what, I guess, the fact that a recession's been declared, will that impact decisions by the Fed or by the government to provide additional economic relief? Governors are still calling for it.
Well, look, I think the bottom line is the Fed has made it crystal clear that they're going to do everything and anything they can to try to stimulate this comeback from an economic shock that we haven't seen in our lifetime. So the Fed is going to continue to help as much as they possibly can. So I don't worry about the Fed raising rates or anything like that. Frankly, the $1 million question no one knows the answer to that's going to determine how fast we come out of this is on the medical side. What's this virus going to look like in the winter months? If it's not going to spread the way that medical professionals originally had feared, and we don't see the spikes that they had warned us about, then I think we're going to have smooth sailing. There'll be bumps along the road, but nothing like we had originally thought when the medical professionals came out and talked about how drastic this could be in the winter months during flu season.
When it comes to the stock market, if you look historically, there have been periods of decline, and then the stock market slowly builds back up. I know we mentioned the Fed pumping, so much money in stimulus. Is there any concern that that we're missing out on just a natural thing that happens with markets, that they pull back at times when the economy slows down? Are we artificially, should we be worried about artificially inflating the markets?
Look, I think that's a very valid point. That's one of my concerns in all of this is some of the things that had to be done to kind of stabilize the bond markets and the liquidity markets is basically borrowing a lot of money and that expectation that the Fed is going to bail everybody out. Look, the bottom line is the unfortunate reality is businesses are going to have to fail. You can't bail everyone out. And so that is the long-term concern I have structurally of how things are going right now is the massive amounts of debt that we are accumulating as a country as well as on the corporate side. Eventually, you got to pay the piper. And if you get too much leverage, that just forms bubbles that when they do drop or bubbles burst, it can be extremely ugly.
Yeah, I mean, I don't know. It's just some. Thanks for answering that. Honestly, it's just something I've been thinking about as I'm watching the market, and the action from the Fed. In the retail sector specifically, we are seeing a lot of bankruptcies. Tiffany and Co. Their earnings came out this morning. They missed on both the top and bottom lines. What do you think the future is for luxury retailers?
So I don't like retailers as a whole. I haven't liked retailers for a few years. I call it the Amazon effect. And I think this stay at home economy that we've been in for a couple of months is going to only continue to hurt the retailers. That brick and mortar retail business model, in my opinion, is dead. I think the future is going to be on e commerce. As you can see, those companies in those spaces are going to just continue to get more and more market share. On the high end side, frankly, it's really going to be dependent upon the job market and how we come out of this economy. If the economy comes back strong and the equity prices stay high, that high end market, there'll still be demand for there. But overall, the brick and mortar retail business is not anything that I would want to be in as an investor.
All right, Eddie Gabor, co-owner at Key Advisors Group. Really great to have you on this morning. Thank you.